So Clay, tell me what's the difference between an FHA and a VA loan mortgage and a regular loan?
Sure. A FHA mortgage, VA mortgage, they are regular mortgages.
Okay.
The only difference is they're HUD insured, meaning that in the event that the borrower would go in default on the loan, HUD would step in and reimburse the bank for whatever money they lost. So it's actually a lower risk loan. They're not actually loans for people with bad credit as the people commonly believe. They're not there for people who don't have money to purchase a house. They're just government insured loans. That's it. They operate in many ways just like a regular conventional mortgage.
Clay, exactly what is a rate reduction?
A rate reduction is a program that HUD established for FHA and VA borrowers approximately 20 years ago that allowed the borrowers to actually take advantage of lower rates as they became available, lower their payments without any of the hassles of requalifying, any appraisals or any of the applications associated with getting a regular loan. Therefore, if the borrower's situations changed, the borrowers could take advantage of declining interest rates at any point without any penalty.
Clay, what types of individuals can participate in the program?
All right, for a rate reduction, anyone with a FHA or VA loan in good standing, meaning that they're current on their mortgage currently, regardless of their past payment history, is eligible for a rate reduction. It's just a matter of registering their loan. Most people don't know when the opportunities to lower their rate become available. It's not really something that's easy to track for the average consumer. But once someone is monitoring the loan for them, and that rate becomes available, almost everyone qualifies. I'd say 75% of Americans with FHA or VA mortgages at some point could have lowered their interest rate and thus lowered their payment.
Clay, what are the costs involved in your program?
In our program, there are absolutely no cost involved to the consumer in almost all instances. We actually incur the cost of transferring the loan, the title fees, the recordation costs. We actually incur the cost of taking the loan and lowering it to an existing, to a lower mortgage payment. We actually cover all those costs. With many rate reductions out there, the consumer does incur the cost of the title fees, the recordation and all the attorney fees. As you know, attorneys work for free. You know, the attorneys charge money in order to do these transactions, but we actually incur those costs in order to help people get into the lower rate loans with our program.
So if a person currently has an FHA or VA mortgage and they go through the process of doing a rate reduction with you, is that going to have a negative impact on them at all?
Not at all. No. That's a common concern that borrowers have, since very frequently the lender was kind enough to extend them credit and give them a loan. They worry that if they try to renegotiate the loan term, it will put them in a negative light. The program was actually created to allow homeowners this option to lower their interest rate. The lender that they currently have their loan with does not lose money as a result of them taking advantage of a rate reduction. They're not going to lose anything by doing that. It doesn't hurt their credit in any way. And let me preface this, or let me back this up by saying that the program really was not created to help consumers. The program was actually created to help HUD keep their default rate at a minimum. Because obviously people who have higher interest rates may have higher payments. Mm-hmm. People with higher payments are going to obviously go in default faster than people with lower payments. So the program was created to help HUD, but as a result, consumers can benefit by using it properly.
Clay, why is timing important with your program?
The timing is imperative because unlike a regular traditional refinance, where the borrower just looks for an interest rate and locks the loan, we have to make sure that there's an investor prepared to incur the cost of the settlement fees and everything, in addition to giving the borrower a lower interest rate. Timing this is really difficult. It's not the easiest thing. So when we have a rate that's being monitored and we see that opportunity, that's when we contact that borrower and say, based on the market conditions here, we're able to do X, Y, and Z to get your payment lower. And we only have a limited amount of time because, as you know, the markets fluctuate. The markets change daily, if not several times a day. So it's very time sensitive, but we've mastered this.
So this is obviously something a consumer can't do on their own.
They're very astute, but I would say in most cases, the techniques we use, it would be very difficult for people to reproduce. We have software that we spend over $100,000 developing just to take care of this for us. Is that difficult, that complicated, I should say.